Okay, hi everyone, Daryl here from Easily. We are an accounting and corporate service provider. So what we do is that we provide accounting, bookkeeping, and corporate secretarial services. Okay, this is going to be the first video in our financial accounting playlist. And today I'm going to talk about just a very brief introduction to financial accounting. So for you guys who are listening to this video, you would most probably be here because you want to learn the basics of financial accounting so that you can properly manage and compile your company's financial statements, or you may just be here for a refresher. Okay, in Singapore or in many places around the world for that matter, at the end of every financial year, companies will need to compile their financial statements to be tabled at the company's annual general meeting. Okay, so we have to understand a few basic financial accounting concepts before we can proceed to compile the financial statement. And in today's lesson, right, we will touch on these 6 terms. They are namely assets, liabilities, shareholders equity, revenue, expenses, and dividends. Okay, if you want to understand financial accounting, you have to understand these 6 concepts. Okay, we will also need to understand the concept of current and non-current or long-term, okay, which applies to assets and liabilities. Okay, so let's touch on current and non-current first. Okay, so current assets are assets that are expected to be used up in 1 year. For example, maybe you are running a supermarket and then one of your assets is maybe rice or milk. Okay, so you purchase rice or milk and you are selling it to the consumer, and this rice and milk is expected to be used up within 1 year. In fact, it's expected to be used up maybe in like milk maybe in a week, and then rice maybe within a month you're supposed to sell it off already. Okay, so non-current assets are assets that are not expected to be used up in a year. Typically, if you buy a laptop, you would consume this asset over a course of a couple of years, but something even more which really defines non-current assets or long-term assets would be something like a property. So if the company purchases a property, this is a non-current asset. The non-current asset, right, is actually consumed over a couple of years. The property can be for perpetuity, especially if it's freehold. Okay, so assets and liabilities, right, you have to tag the current and non-current portion to assets and liabilities. We'll show you guys some examples moving forward. So assets are things that a company owns that can produce future economic benefit. In short, things of value. Okay, assets are quantifiable, so you can place a dollar value to an asset. Some people say, oh, my asset is my degree, but you can't place a dollar value to this degree. So in terms of financial accounting wise, right, the degree is not your asset. So example of possible assets on the company's balance sheet, right? Okay, so assets and liabilities, they end up in the company's balance sheet. So example of possible assets on the company's balance sheet are cash, accounts receivable. So cash is cash. Accounts receivable are like if let's say the company invoices somebody and then that somebody or that company owes your company money, so this is actually accounts receivable. You expect to collect back this amount from that individual or that company in the near future. Okay, so then inventory like computers, laptops, machinery. If you purchase a vacuum cleaner, so that's your inventory. Property, plant and equipment is actually one term typically used on the balance sheet. That's property, plant and equipment. When they speak about property, right, they're most probably talking about land. Plant is actually the building which is on top of it. Then equipment are the equipment which are inside the building. Okay, so it's a little bit different when it comes to financial accounting terms. So if maybe you're an economist or something, you tend to or you're a property agent or you're dealing with real estate, then you would maybe deem these terms slightly differently. But on the balance sheet, right, when we mention property, plant and equipment, right, these are the main ideas of what it is. So property is actually, we're most probably speaking about land once again. Plant, the building on top. Equipment is the equipment in the building. Okay, so examples of current assets. Current assets, like I mentioned, they are to be used up within a year. So cash is the most common current asset. Accounts receivable, so you expect to receive normally when you invoice out when you send an invoice out to somebody, so that person or that company is expected to pay you. Maybe you give them 7-day payment term, so within 7 days they're supposed to pay you, or 14 days, or maybe within a month. Okay, then temporary investments, maybe you can purchase some assets on the stock market temporarily because you got some spare cash. So these are called temporary investments. In office supplies, you purchase like writing pen, hole punchers, staplers. These are called office supplies. These also form part of your assets under your balance sheet, and these are current because you expect to use up these office supplies within the year. So examples of non-current assets, right, are long-term investments like land. Maybe you buy a building, you invest in an office. The company invests in an office for that matter. Laptop. So laptop, typically you would have your laptop on the balance sheet over the course of a couple of years, maybe until it spoils, maybe 5 years down the road or something like that. Then you have to dispose of it. Vehicle. So if you buy a lorry, a van, these are non-current assets because you don't use up the vehicle within 1 year. Then you purchase a property, a plot of land, or you buy a building, office. All these are examples of non-current assets. Okay, so liabilities are things that the company owes. Liabilities, once again, they are quantifiable. So you can place a dollar value, to the liability. This to the liability. There's a typo here. So examples of possible liabilities on the company's balance sheet, right? Accounts payable, which means that you are liable to pay somebody. So like maybe you are dealing, maybe you're a restaurant, and then your supplier supplies you meat and vegetables, then they send you an invoice. So this forms accounts payable. Okay, so notes payable, so long as when in accounting terms, right, this notes payable is basically when someone writes you a note, an IOU, like a promissory note. That means you promise to pay this amount of money within a certain period of time. Mortgage loan, let's say you purchase the company purchases a property, then they take up a mortgage. So this mortgage is written in a contract. That's why we call it notes payable. Maybe you take up a bank loan, a long-term debt. Okay, so like a bank loan, right? Maybe you take a bank loan to maybe to expand the business, to expand the company, to maybe come up with a separate department so they can hire more people. So when you take up this company loan from the bank actually drafts you a loan document, and this loan document is this thing called notes. So when you call it notes payable, right, generally there's a contract that is formed in a written agreement, and that's why we call it notes payable. Okay, so examples of current liabilities are like accounts payable, like I mentioned. So you are liable to pay your supplier, in the example of a restaurant. Then the salaries payable, right? So of course you need to pay your staff. Your staff is not going to wait for you for 1 year to pay them. Okay, so most probably if they work for you for the month of September, then on 1st of October you are liable to pay them for their salaries. Okay, then examples of non-current liabilities, which means that these liabilities are not supposed to be settled within 1 year. Mortgage payable, like I mentioned earlier. Bank loan payable. Of course, there are bank loans which are shorter than 1 year. If in that case, right, then that will be a short-term bank loan payable. Then it will fall under current liabilities. But generally, bank loan payables they tend to take longer than 1 year. So that's why bank loan payable will be an example of non-current liabilities. Then any long-term debt. So if the company takes on long-term debt, right, it will be under non-current liabilities. Okay, so the assets and liabilities is quite simple. Then the less obvious one, right, is this idea of shareholders equity. So shareholders equity is basically the value of all assets less liabilities. Okay, so the formula to remember is assets minus liabilities equals to shareholder equity. I like to use this example of maybe purchasing a property. So the property, as an individual, you think of it as an individual, then you understand this idea of shareholders equity. So if let's say you purchase a property for let's say 1 million Singapore dollars, then you have an outstanding loan of about let's say 700,000. So if you sell the property for 1 million, you purchase a property for 1 million, that forms part of your asset. Then you owe the bank 700,000. But today when you want to sell the property is worth 1.2 million. So what's your liability? Your liability is 700,000. So you take the 1.2 million minus 700,000 equals to 500,000. So this 500,000 is your cash profit. And shareholders equity is essentially cash profit. That means that if you liquidate or you sell off the company, all the assets of the company, and you less off the liabilities, that means all the outstanding loans and all the money that you owe to, or the company owes to its creditors, right? Then the remaining money that is returned to the shareholders is shareholders equity. Okay, so in short, shareholders equity is the concept of when the company is liquidated and all liabilities are paid off, then the balance is shareholders equity. Okay, so the shareholders equity can be a negative value. Just like if you purchase a property, right, then you sell your property. Let's say you sell your property for $1.2 million. The same property, right, instead of selling for 1.2 million, maybe you sell for 500,000 because the property market did very badly. But you owe the bank 700,000. So you still have a negative of 200,000. The bank will ask you to top up. Okay, so shareholders equity can be negative if liabilities are more than assets. We call this accumulated deficit. Okay, you don't really need to remember this term accumulated deficit. I'm just sharing it with you. So an accumulated deficit arises when the cumulative amount of losses experienced and dividends paid by a business exceeds the cumulative amount of its profits. Try to internalize this, but generally this means that shareholders equity is negative. Okay, so the accounts under shareholders equity, or the items under shareholders equity, right, are common shares, preferred shares, and retained earnings. So what are retained earnings? Every year when the company makes money, they can choose to do two things. They can choose to issue out dividends to the shareholders, or they can leave the earnings inside the balance sheet of the company. So if you leave the earnings or you leave the profits inside the company, these are called retained earnings. Okay, so shareholders equity under this account, right? Shareholders equity, there are items like common shares, preferred shares, and retained earnings. So retained earnings and dividends, right? There are two items that that's how it's either you pay back the shareholders in terms of dividends, if not then you keep the money with the company, which is retained earnings. Okay, so the other three terms, right, which are, I wouldn't say less important, but they are still important for you to understand out of the six terms. So revenue is just basically the money that the company earns. So an example would be rent collected, or let's say you have collected consultancy fees for providing consultancy to another company or to an individual, then the company earns consultancy fees, right? These are called revenues. Okay, basically they are money that the company earns and collects. Okay, then expenses are costs that the company incurs. So common costs would be like income tax expense. So you have to pay your income tax, your corporate tax. Okay, your salaries expense, you pay your workers the salaries. Supplies expense, that means that supplies expense, right, and supplies. So the first asset, right, there was supplies, right, then this supplies expense. So for example, if let's say you purchase $100 worth of printer ink, or $100 worth of printing paper. Printing paper is something very common because every company runs through a lot of printing paper. Let's say you buy $100 worth of printing paper, then you use half of it. So your supplies expense is $50 of printing paper. Okay, so so that's supplies expense. Then you have to pay things like utility and phone bills. So these are expenses as well. So dividends are paid back to shareholders from the profits of the company, like I mentioned before. So if you don't pay out dividends to the shareholders from the profits of the company, then you will be keeping it under the company as retained earnings. Yep. So remember, these three terms are very important. You guys got to know them, and we'll follow up with a couple more videos and from time to time to keep you guys up to date and up to speed with your financial accounting knowledge, so they can help you run your companies better. Okay, if you want to contact me, I'm Daryl. I'm the director of Easily Private Limited. We are ACRA registered filing agent, so we're a corporate service provider. This is my contact number, so you can contact me by call, SMS, or WhatsApp. This is my email address, so you want to contact me is daryl@easilycorp.com, and this is our company's website, easilycorp.com. If you're looking to incorporate a company or you need someone to provide you with corporate secretarial services, you can always look for our company. And yeah, that's all, and I'll see you in the next video.